is dead. Well, not the structure. The structure is thriving. It's actually exploding. But the idea that an ETF is a sensible, low-cost, set it and forget it tool of your future, that idea is systematically dismantled. I have been looking at data lately. It's unsettling. For 30 years, you were told the ETFs were the light. They were the cure for the high-fee, underperforming darkness of mutual fund industry. But something has shifted. In 2025 alone, over 1,000 new ETF launched globally, with growing share in active and complex strategies rather than plain index fund. Most of them weren't simple index trackers. Many were active, outcome-based, thematics, or leverage products carrying much more higher fee than the original Bogle-style beta funds. For the first time in history, there are now more ETFs in the US than there are individual stocks. Think about that. There are more recipes than there are ingredients. We have reached a point where the fund management industry is launching hundreds of new products every year, and most of them aren't designed to improve your life. They are engineered to attract your assets. Most of the ETF being launched today are engineered to fail you. High fee, narrow, complex, or time-based product that on average lags simple broad market benchmark over time. That's hard to hear if you have to spend the last decade moving your money into these wrappers. But an ETF is just a box. It's a wrapper. And if you put a pile of high-fee garbage inside a sensible box, is it still sensible? We have entered the age of slop, financial product of low-quality products in massive quantities, layered on top of the original low-fee core. And your brokerage account is the primary target. How did we get here? And most importantly, how do you tell the difference between a building block and a landmine? I have been thinking about why we trust these things so much. Why does the word ETF makes us feel safe? It's because of the halo effect. Let's go back a little. ETF were invented in 1990s, so people could buy a mini pack of lots of stock at once, kind of like buying a bag of mixed candy instead of picking each piece one by one. They have become super popular because in their original form, they were usually cheap and easy to buy than traditional mutual funds. What are mutual funds, you ask? Long ago, businesses needed money to grow. Instead of borrowing from a bank, they started selling tiny pieces of the businesses called stock to people. If you buy a stock, you own a small piece of that company. If that companies do well, your piece can become more valuable. So stock equals tiny ownership piece that helps company raise money and help people try to grow their savings. But the problem with stocks, owning just one or two is like eating only one type of food every day. If that one company gets sick, does badly, your money gets sick too. People had problems, not enough money or time to buy many different stocks, hard to research companies and manage everything themselves. So people wanted an easier way to spread the risk and let a professional do the work. That's where the idea of mutual fund were created. The idea came, what if everyone put their Lego bricks money into one big bucket and professionals build a big mixed Lego castle or a portfolio for all of us? That big shared bucket is a mutual fund. Many investors pool money together. A fund manager uses that pool to buy lots of different stocks and bonds. Each person owns share of that fund, not an individual stocks directly. Main reasons mutual funds were needed was diversification. Your risk is spread across many companies. Professional management, someone full-time study market and decide what to buy and sell. Access, small investor can participate even with little money. The modern version, the open-ended mutual fund, show you a price once a day after market closes, called NAV, net asset value, and you buy and sell at that price. Mutual funds were a huge step forward, but they had some frictions. You can normally only trade once per day after market closes. Fees could be higher, management fees, sometimes sales load. They are not bought and sold directly on an exchange like a stock. As markets got faster and more global, big and small investors wanted something as diversified as mutual fund, but trades all day like a stock, often cheaper, especially for simple index strategies. That sets the stage for ETF. Exchange traded funds are like mutual fund that behaves like a stock on exchange. They were introduced in early 1990s to cheaply copy broad market indexes like the whole Canadian market, the S&P 500. When we hear the ETF, we think about Vanguard, we think about 0.05% fee, but the industry know that they are using that trust to wrap the same high fee speculative junk we used to hate into a package that looks modern. Look at the cost. While low fee were the hallmark of early ETF success, many new complex ETFs launched with fee in the range of 0.5 to 1%, far above core index fund that charges around 0.03 to 0.1%. That is exactly what we were running away from in the mutual fund world. The industry isn't innovating to help you anymore. They are innovating to survive you. Why wouldn't they? The S&P game has been won. Vanguard and BlackRock owns that territory. If a new company wants to make money today, they cannot just launch another index fund. They need a story. They need slope. Does more choices make you a better investor, or does it make it harder to find the truth? Get all the upside of the stock market, but none of the risk. That's the pitch for buffer ETF. They call them defined outcome fund or shock absorbers for your portfolio. It sounds brilliant. Who doesn't want shock absorbers? Who doesn't want to sleep through a 15% market crash without losing a cent? But let's look at the math. These funds uses expensive derivatives to create a floor. The upside is capped. In exchange for that floor, your gains are limited, often to a fixed cap over a 1-year outcome period. The fees are massive. While standard index fund costs you around nothing, these buffered version often charge 0.7% or more in annual fee. The protection is inconsistent. Research on outcome-based ETF shows that losses can still exceed what the simple marketing diagram suggests, especially outside the defined outcome window or often large moves. A simple mix of cheap index fund and cash can often deliver comparable or better long-term outcome than these buffer funds, even through market drawdowns, once you account for caps and fees. Why do they even exist? They exist because you are afraid. The industry has realized that fear is more profitable than greed. They are selling you a solution to a psychological problem, and they are charging you a huge premium for that privilege. If you cannot sleep without a buffer fund, the problem is in the market. The problem is your asset allocation. But buffer funds are just the beginning. What happens when the industry stops trying to protect you and start trying to help you win? If you think a stock is going up, why buy 1x when you can buy 2x or 3x? It seems like a simple math. If the S&P 500 goes up 10%, a 2x ETF should go up 20%, right? It's right there in the name, Ultra Bull, 2x long. Except it's not simple. It's a math trap called daily rebalancing. These funds are designed to give you a double returns for one single day. At the end of every day, the manager has to buy more if the market went up or sell if the market went down to reset that leverage. This creates volatility drag or volatility decay. Think about this scenario. Day 1, the market goes up 10%. Day 2, the market goes down 10%. In a normal account, you are down 1%, 100 to 110 when it goes up 10%, and down 10% from there, you get 299. In a 2x account, you're down 4%, from 100 to 120 when it goes 10%, that becomes 20%, so 120, and then from 120 down 20%, that is 96. If the market stays volatile but ends up flat, a 2x ETF will slowly bleed away even if the index hasn't moved a cent. You are paying for the privilege of buying high and selling low every single afternoon. Mathematically, the volatility tax grows with the leverage and volatility. You aren't just betting on the direction anymore, betting on the path. If the path is bumpy, you lose. Does that sound like an investment to you? Or does it sound like a casino game where the house takes a cut of every single swing? Even regulators are worried. Recent SEC action has specifically flagged concern about high leverage ETFs and the risks they pose to retail investors. The thematic graveyard. AI is the future. Clean energy is the future. The metaverse is the future. We all want to be early. We want to be the person who bought Apple in 2001, Amazon in 1997. Thematic ETFs capture that imagination. They give you a way to invest in the next big thing before everyone else realizes how big it's going to be. But here's the data. Research on thematic ETF find that issuer tends to launch them after the team has already delivered strong returns and evaluations are elevated. On average, thematic funds underperform broad market benchmarks by several percentage points per year over the year following launch. Only a small fraction both survive and outperform over the long horizons. The industry isn't giving you a seat at the table of the future. They're handing you the bill for the party that just ended. Think about cannabis in Canada. At the peak of the hype, cannabis and other ultra-narrow themes dominated the thematic ETF shelves. After the bust, those products shrank to a tiny fraction of the market, or were closed or merged away. Changing the world and making a profit are not the same thing. If the market knows AI will change the world, a lot of that growth is already priced in. To win, you don't just have to be right about the story. You have to be more right than the collective wisdom of every other investor on earth. And yet, we keep buying them. Why? Because we love shiny objects. And fund managers are very, very good at making objects look shiny. Why settle for a 2% dividend when you can have a 12% distribution yield? This is the fastest growing part of the Slop market, covered call ETF. They have names like yield maximizer or high income share. It sounds like free money. You keep your stocks and the fund sells option to generate cash flow. But there's no such thing as free money in finance. When you sell a call option, you're selling your upside. If the market goes up 20%, you might only get 5 to 10% because your gain above the strikes are capped. If the market drops 20%, you take almost the entire loss. The option premium is small cushion, not a shield. You have created a systematic bet where you win small and lose big. The total return of these strategies mechanically trails the underlying equities most of the time, especially in strong bull markets. If your ETF pays you a $1 distribution, the share price of that ETF typically drops by roughly $1 because that cash leaves the portfolio. You aren't getting rich. You are just liquidating your house one brick at a time and calling it an income. People have cult-like devotion to these yields, but your net worth doesn't care whether the money comes from a dividend or a share sale. The total return is what matters. Analysis comparing covered call indices to the underlying shows that an investor who just owns a regular index fund and sells a few shares when they need cash often ends up better off than the person buying these high-yield wrappers. So why do people love them? Because we are biologically wired to love the feeling of a check hitting our account, even if it's our own money being handed back to us. We have reached the final circle of ETF Inferno, the single stock ETF. This is the ultimate evolution of the Slop. It's not even a diversified fund anymore. It's just one stock, like Nvidia or Tesla, wrapped in 2x leverage or a covered call strategy. These are tools for pure speculation, marketed to retail investors like they are just another sensible ETF. They're incredibly complex under the hood. They're often use swaps and derivatives instead of simple borrowing money, meaning cost and risk are embedded in the contract structure. Analysis of hypothetical leverage single stock ETFs shows substantial underperformance versus single buy and hold benchmark because of volatility decay. In volatile names, a 3x single stock ETF can see several capital erosion over time, even when the underlying stock ends up roughly flat, purely due to that volatility drag. Even the SEC has stepped in to scrutinize and slow down ultra-leveraged ETF plans, explicitly warning about the risk and complexity for everyday investor. At this point, picking individual stock is risky enough. The last thing you need is a tool that makes it easier to blow yourself up on your phone while sitting on the bus. This is the gamification of your future. Your brokerage app is starting to look like a casino. And single stock ETF are the high-stake table at the back where the lights are brightest and the odds are the worst. John Bogle, the father of index fund, saw this coming. Back in his later years, he called the ETF the most successful financial market idea of the 21st century. He warned us to beware of products that are new and hot. He was right. We are in the age of slop. The industry is dumping thousands of trashy novels on top of the classics. The good, boring, low-cost index funds are still there, but they don't have a narrative. They don't have a yield maximizer. They don't have a promise to protect you from your own fear. Complexity is a tax. In finance, complexity is almost always transfer of wealth from you to the person selling the product. They need complexity to hide that fee. They need stories to distract you from the fact that doing nothing in a low-cost, diversified index fund has beaten most fancy strategies over time. The ETF Slop is only going to get worse. There will be more fun next year, more themes, more solutions to problems you didn't even know you had. The question isn't whether the slope is coming, it's already here. The question is, can you resist? Can you sit there with your boring 0.1% index fund while your neighbor tells you about his 15% yield? Can you watch the world change and not feel the need to lever up on the future? The hardest thing in investing isn't the math. The math is simple. The hardest thing is the silence.